Good afternoon, ladies and gentlemen. It's lovely to see you all. I'm Bernard Johnson, the Group Managing Director of Creightons PLC. I'm very grateful for the opportunity to present to you the results for the year to the 31st of March 2019. It's been a pretty good year. Before I start, by the way, we have a team with us. Pippa is our Group Sales and Marketing Director. Paul is our Finance Director, our Manufacturing MD, and responsible for commerce, wide brief. And we have Martin Stevens with us, who is our NPD Director, Technical Director. And this team has helped, together we've, over the last 10 years, put this company together and formed a very strong team underneath. So we're very people-oriented. They've done a great job, and they have people coming behind them doing a great job. So that has led us in this wonderful year to have increased sales from well up in the previous year. I'm not going to take away Pippa's thunder on that and go into detail, but it provides us with a platform for continued growth and profitability, which we're determined to maintain. We have challenged by the growth. We've been challenged on our operations, our warehousing, our production, and our manufacturing sectors. And we have very successfully coped with that. And we're in a position to say that we could cope with greater growth now. And as part of that growth, we have a few significant acquisitions in mind. We would like to conclude on buying the 11-acre site that we sit on, very valuable site. And we've successfully negotiated that with the owner, who also happens to be a major shareholder. We're in the course of doing that. It probably will involve a C1, Paul. So we'll have to be in touch with you guys in the very near future. It's more or less a done deal, and I think it's very good for us and for our future. We're looking very closely at and have signed letters of intent and exclusivity on a retail website, turning over about 8.5 million, going towards 10 million. We're quite regimented about this. We want to do a very detailed due diligence, and it may or may not happen, but it's there, and it's a statement of our intent. We want to get into the internet side of the business because in 5 years' time, we feel that 50% of what's being bought and sold in the health and beauty business will be on the internet. Will be digital, whatever you want to call it. And we have actually concluded that in the last few days. The third one there, which is a fast-growing young brand. It's the Balance Active that you see in front of you there. It's very active. It is very active, very well thought of by the customers that it's being sold to at the minute. We have great hopes for it in the export market on the web, and with other retailers that we plan to bring it to. It's turning over 1.2 million. It cost us $500,000. I think we'll have a quick payback on that. So going back to the main theme is that we're very people-based. We feel that we get our growth from having good people who follow our mantra of quality, service, and innovation. And we deal with we see our customers as the consumer, and we keep a close eye on that. So we've instituted continuous training of all marketing, product development, and account management, customer services people. And we like to think we reward them reasonably well in terms of competition. All employees earn a performance-based bonus of around 7.5%. The lowest paid received an average of 9.55, which isn't bad for the Peterborough area, and reflects the fact that we believe in looking after our employees. They're part of the team, they're part of their shareholders, they're stakeholders. We actually offered them share options, been in existence now for over 6 months. The point is that all our employees have now got share options, and we want to keep them rolling on that basis without damaging or diluting too much the share capital of the company and without affecting too much the share price. We want to develop a more sales-led culture because we are very good in marketing and we're very good on consumer evaluation of our products and developing what the consumer needs and the customer needs and the retailer needs. But we actually don't drive very much. We may not call on certain customers for weeks on end. There's not a systematic sales team. So what we've got by being good at what we're doing. We now want to improve our ability to sell under, and we've recruited a young man, by my standards anyway, who's originally with at a senior level in McBride's PLC. So he has some PLC experience. He has experience in a very important part of our business, which is the private label and contract, which is really 2/3 of our business. And I think he'd be a great addition to our team. He will start in the beginning of August, I think, or somewhere in August. And that will lead us into a whole new area to consolidate our sales. And we are upgrading our web sales function using, developing our own platform. So a lot of our stuff, we only sell $500,000 a year, but we intend either by buying websites or by doing it ourselves to be at the 20 to 30 million in a few years' time. So we're using a company called IRP Export Technology, who have got a track record of boosting sales in companies like ours. And that leads me on to offering the stage to our finance director and production managing director, Paul Forster. Thank you.
Welcome again. I'll echo the welcome to everybody. You'll have probably had a chance to look at the financial highlights that have been out, and this covers a lot of those. I'll go into a little bit more detail, but I'll go through fairly quickly and then leave for questions later on, because I think going through the branded and marketing things with Pippa is probably going to give you a better feel of where the business is going from a marketing point of view. And the main highlights have been disclosed this morning. Revenues up 26%, nearly £10 million. If we hadn't have recalculated our sales on IFRS on the new revenue, it probably would have been closer to 10 million than it's showing there. But it's a significant growth in the period, all organic growth coming from new customers and new growth with the existing customers, some of which has been quite significant. The operating profit up 77.4%. I've concentrated on that because the tax is a bit complex this year. So 2.9 million to 1.6 million. And in the report, we talked about the gross margins coming down roughly 1%. So that operating profit has been achieved despite that growth margin percentage reduction. And I think we mentioned in there that is largely customer mix. So some of that sales growth has come from customers with a lower average margin, but it has contributed obviously to the overall. Within the period, we had raw material and other price increases, but we put programs in place to really drive cost reduction, and that has delivered quite a significant margin improvement within that deterioration we talked about. And that program's ongoing. We still feel as though there's more mileage in there, the cost reduction programs, and we've invested in more Far Eastern resources, some structure and a structure to support Far Eastern sourcing, again, to gain access to overseas pricing. And that will be helped with Balance Active, which actually does have a significant Far East sourcing part of the business. So the operating margin up virtually 2% to 6.6%. Again, that shows the fact that we've constrained overheads within that period. The fully diluted earnings per share, I'll come back to a little bit of a calculation on that later, but that shows significant benefit. Also, the tax obviously has helped drive that higher than we would normally have done. And the proposed dividend, we've increased to 0.4p per share. It was, when we were looking at it, 1.5% on the 35p when we were just preparing this slide, but obviously that share price has moved since and changed that. We've been claiming R&D tax relief through a firm of accountants for a while, but we were introduced to a new consultant by Nick, our company secretary, who came on board last year, and they revisited the R&D and had a much more, they're specialists, but they had a much more aggressive approach, I think. Aggressive is a good phrase, approach to how to do that. And they identified that we were doing much more R&D than the previous people had identified. So we effectively got 3 years benefit in here, 361,000 for 2 years and another sort of 170,000-ish for this year. And I'll explain that a little bit more, but it really means that our underlying tax rate, if our business mix still has the same level of R&D going forward as we're doing at the moment, would be around about 13% rather than the 19% at the moment. And the way the business is and the activity we're doing, that should be sustainable. So that's effectively, had an artificial impact on that earnings per share. So we're talking about the revenue here, again, 26%. I've done this theme through the slides here, 2016, and just compared 3 years, we've more than doubled the turnover in 3 years. I think I mentioned at the half year that the half year we delivered the same as the full year in 2016. Well, we've maintained that. As again, we disclosed before, 42% has come from private label, contract sales up 32%. Branded's not been as big as that, and I think people will talk a bit about the sales mix later on, because we've had a bit of a change in the sales mix within the branded. The little white bits on there, the old Real Shaving brand, for those of you who've been around a while, we sold that brand. And so if you ignore the reported figures, there was 1.4 back in additional sales from the Real Shaving brand. But it gives you an idea of where we've taken the underlying business. Again, the operating profit, 77%, I've already said, 4.8 times increase in 3 years. I think that's a fairly significant statement of where we've come. Distribution costs have grown quite significantly, and as Bernard mentioned, we ran out of space basically. As we grew the business, we needed more stock. We chose to outsource our finished goods to a third-party logistics provider, the finished goods sale, stock, storage and distribution. So there was a one-off cost as we managed that transfer. But what that's meant is we've been able to bring more production in-house and keep the components in-house and streamline and continuing to streamline the operations. And we're also looking at moving some production between sites to balance up activity. So between the Tiverton site and the Peterborough site. So again, it's allowed us to look at moving forward for the future. And so whilst that's growing quite a bit, the underlying overheads have only grown by 11%, the admin costs continue compared to that 26% growth in profit. What I've tried to do here on that operating margin, it's one of our key, I suppose, ambitions is how we measure ourselves, has been to improve that operating margin. The reported figures are the solid lines, but what I've done here is just shown the outsourcing costs. We made a few years ago, we made a conscious decision to outsource production in order to keep the sales drive going. We knew it was going to have a cost associated with it, but we felt that was the right decision to make to deliver the sales growth for the future whilst we invested in the operations of the business. And you can just see that whilst there was a dip last year, the operating profit, really the underlying trend is a continued improvement and underlines that decision. And again, back to my theme, 2016, the operating margin's up 2.5 times from 3 years ago. I've tried to explain the R&D impact on this slide because this year we've had that one big credit this year, which has improved the post-tax profit. But what I've done with the blue lines is said, well, if we'd have adjusted for prior years, so you see the underlying trend in the post-tax profit on the solid lines. So excluding that credit for 2017 and 18 in these figures, we would be at 5.7% on that line. And as I mentioned a little bit earlier, we're feeling 13% is a sensible underlying level for our tax rate going forward. Diluted earnings per share, and it goes back to this is the fully diluted figure, taking account of all of those share options. And I think it shows that actually motivating employees has benefited in driving the earnings for individual shareholders. The 4.6, it would actually be 3.6 if I took, again, that normalised share tax rate, would be 3.6%. But we're looking at a 5 times increase in earnings per share since March 2016. Return on capital employed, again, one of the performance measures as we set out in 2017 that we've talked about in the past. We're up now at a return on capital employed of 24%. We are, again, 3 times nearly since 2016, that's improved. So we are working the assets. We're looking at these acquisitions. Again, these acquisitions are coming out of existing resources. We don't need, we're looking at funding everything we need within existing resources. So no reason why that shouldn't continue to improve as we go forward. Cash, I want to explain this a little bit. We've invested in working capital as we've gone through the year. We made a conscious decision to invest in stocks ahead of Brexit. We probably, in hindsight, over-egged that, like a lot of other businesses. The operating cash flow in the period, if you look at it, generated out profits of 4 million. We increased working capital by 2.7 million, so that was absorbed, of which 2.7 million is stock. We spent on capital items and intangible items, 1.6 million in the period, and the intangibles mainly product development. So that's where the money's gone. We also, the gap, if you like, between the 200,000 in the bank and the 500,000 credit is also the payments of tax and then the dividends to shareholders. So you can see where that money's gone. We unravelled the middle of March. We started looking at the stock levels and started thinking, time to unravel everything. So we consciously unravelled ahead of the Brexit deal, was obviously not happening. And since that period, we've reduced stock by 1.3 million since the middle of February. And that has rolled through into operational cash. So I'm looking at a cash position this morning of 1.5 million in credit. Got salaries to go out at the end of the month, but we've sort of turned that investment round since the year end. And that's given us a platform to start looking at some of the deals Bernard's talking about. The working capital facility headroom at March is 5.5 million. Again, gives you an idea that we've got the potential to move forward. Whilst I'm talking about that, Bernard mentioned about the property, and we've secured funding at an 80% loan to value on that property. And a margin rate of 1.8% over base, which I think is pretty competitive rate. All of this has got to be finalised with the deal and everything, but it just gives you an idea of the sort of structure and the covenant the business has got that it can get. That's such a low margin rate on that. Talked a little bit about stock, and you can see there that we have increased stock. The stock turn has deteriorated in the period. We're now working hard to unravel that, turn that stock into cash and free it up to enable us to move forward. Whilst I can't continue, that will continue for the rest of the year, but the first 2 months of the year, sales were up 20% on the same period last year. So that's part of the reason for the investment in stock. You invest the stock ahead of the sales. So we've got that. Trade debtors, we've kept in control, and we're now gradually reducing the trade debtors, and they're in line with our expectations at 52 days. So again, we're getting stock back after making that investment running up to the year end, and we're improving our debtor control slightly. We brought new people in on the debtors. Again, part of the function of expansion. Increase the skill level, put more resources in to make sure we get paid on time. And, I think we did a recent trend recently when we were talking to the auditors about the changes for debtor provisioning. Our average debtor loss over the last 5 years when we were talking to them was about £3,500 a year. It's, our trend on cash control and managing risk is really, I think, very good. More challenging in today's market because you can see what's happening with debtors at the moment, with retailers at the moment. It is a little bit more challenging market with going forward. Then looking at where we are on we talked about plans for growth. It was a big feature of ours. How do we cope with the expansion? We've got the new production management team in the Peterborough site. In the last 12 months, I compared March on March last year, and we're looking at 17% increase in activity, 20% improvement on efficiency within the factory in that period. So the unit costs are coming down. Some of that is driven by the investments we've made, which have reduce the unit cost, but a lot of it is about shop floor management and managing the shop floor. So we've made a significant improvement there. Investing in people, Bernard talked about this earlier, we are structuring our investment much more now. We've grown, we've got 340 employees in Peterborough, 100 in the Devon. We've had to structure our HR and management, but we're also changing what have been very broad brush bonuses based on the site performance to put in much more individual performance measures in on people. So that individuals are now recognised for performance, and that's been welcomed, as you would imagine, by the people that perform, which is good for us and good for the business going forward. We are still looking at whether we can change our shift patterns to put more capacity in. We put that on hold because we don't need to do it at the moment with the improvement in productivities. But if we we will look at extending shift patterns. So we work a 2 shifts pattern in both sites. We've got options to extend and move to a 3rd shift and manage growth through the business for the future. All that outsourcing is complete. Capital investment, we put in two high speed filling machines, primarily driven by to drive capacity, but both of them have delivered increase. The tube machine in particular has reduced unit costs on production quite significantly since their introduction. And we're looking now at jar lines and whether we can replicate a similar thing maybe for the early next year. And we've talked about the site. For those who've been there, it's a sort of 11.5 acre site, partly underutilised because its derelict buildings have been at the back and knocked down. So it gives us an opportunity to secure the future of the business and look at how we develop and utilise and, do we bring the warehousing back in-house and construct a warehouse and take reduced costs for the future? Gives us lots of options, but we'll explore that more in detail when we do the circular to shareholders. Right. Last slide was just going back to our aspirations way back in 2017 and where we're at. We said 60 million. We've still got we knew it was going to be a mixture of organic and acquisition. We've delivered a lot on the organic, and we're now looking at some of the acquisitions. So we're 73% there. Let you judge that. 5%, we said after tax. We're at 5.7 on that adjusted basis now. Growth of 45%. Pay a dividend of 2%. It was 1.6 based on the 35p, but we're probably going to fail on that this year. But we're on the track, and what is important is the dividends are up 45% on where they have been. Return on capital employed, we set a target of 20. We're at 24. Prove we are a well-balanced and flexible team. I thought I'd leave that scorecard to you guys, actually, because judging oneself is probably not a good thing to do in this scenario. But I think it's a fair statement of where, if you're looking at a school report card, I think that's a fair judgment of where we are as a business. Right, over to Pippa.
Afternoon. I'm Pippa Clark. I'm the Global Sales and Marketing Director at Creightons PLC. Met many of you before, but there's some new faces. So I'm going to take you through some information on the market and give you some context of the market that we're currently operating in, both in terms of numbers and in terms of trend. And then I'll take you through some of the insights into how we're performing and into our brands and where we're heading as a team. So health and beauty market continues to be very healthy globally. Delivered 9% growth up to 2018 in the UK market. UK is the 6th largest in the world in terms of personal care. Our per capita spend is quite significant and is predicted to be even more significant. That includes beauty services, not just beauty product purchases. So within that 73 to 487. So salon services and beauty services are also growing at quite an exponential rate as well. Hence why the jump in the next 5 years, but product is significant in there too. 2018 definitely saw sustainability and well-being finally coming to the fore and finally being discussed at a mass market level. It's been around for quite a long time in terms of us in the industry talking about it, but the consumer wasn't really buying into it. There's definitely been a gear change in 2018 in respect of those 2 key drivers, and I'll talk a bit more about that and in terms of our role within that and how we can take advantage. Wellness and well-being also is a big driver in terms of spend as well. Also forecast to be at a very similar level in terms of per capita spend, not just beauty spending, but on well-being products and wellness products. UK is leading innovation quite significantly in the global markets with regard to personal care. 37% of all global launches in 2018 were in the UK. We're very prolific in terms of bringing new products to market, and our consumer base in the UK being very receptive to buying new products and trying new products. Facial skincare, still biggest category. 71% of launches in the UK were in facial skincare, so a very significant market. Our largest category in terms of value, haircare is our largest in terms of volume, so a key category for us. Beauty online did 8.5% of total beauty sales in 2017 and predicted to grow to 11.6% in 2022. I think that figure, we'll just see it evolve and change. I think it's moving so quickly. I think it's quite difficult to predict, particularly if Amazon come into the beauty arena with the strength that they say they're going to. They're still trialing a lot of stuff in the US. But if they roll that out into the European market, I think we might see that figure change. And it's still very female dominated. There's lots of chat and discussion about the male grooming market, but it is still a very small part of the total beauty market. Females still are a huge part and a huge purchasing part. 78% saturation of females buying into beauty, only 41% of males. So again, 2018 has been very interesting in terms of finally, I think there's been a real consolidation with the consumer in terms of driving what they want, and some subjects coming through that are now talked about on a daily basis and is in mass market. But what is happening, obviously, as we all know, is the retail landscape is evolving quite significantly. You know, department stores are ailing, traditional retailers are struggling, there are different types of retailers coming through. Online, obviously, is having an enormous impact. Smaller brands are able to get to market easier than they ever have been before because the barriers are lower. So that's all changing and evolving, and we have to move and kind of predict what that might look like. Speed of innovation is increasing. I mean, I've been doing this for 25 years and I've never seen innovation in the past 2 years with the speed that it is now. Just to give an example, we've got a fabulous brand that we manufacture for. They are moving at the rate of knots, and their definition of new product development is a product every single week. They're launching a brand new product. They expect short-term innovation to only last 6 months in the market and long-term innovation to only last 2 years. So you can see that investment in continually moving with the consumer and continually driving new product. So speed of innovation is very important. Capitalizing on trend, it's a hand in hand with innovation. The consumer is so savvy, and because of social media and because of the ability on digital to find out so much about product and trend, they are moving so quickly. We need to be able to capitalize on the trends that the consumer's watching and wanting. And there's a high level of acquisition activity in our sector as well. Lots of small niche brands being bought out within literally just a couple of years of existing by the big guys that are constantly trying to buy innovation and bring in these new brands. So some really interesting market drivers. Along with that, you've then got what the consumer is demanding, and they want cleaner products, simpler products, sustainable products. So the whole thing is changing in terms of what the consumer is wanting, and changing insofar as the way that we formulate, the type of packaging that we use, and obviously the way that we deliver it to market. Well-being and beauty and health are central really to everything that's happening in the personal care and beauty industry. Self-care, well-care. We now see beauty as being healthy. Beauty was always aligned with being glamorous. We still want that element, but there's definitely a trend now that the consumer is realizing that beauty is about health. So you're now seeing this rise in well-being and products that deliver well-being. That doesn't mean beauty isn't still a key subject. We still want to look good, but it's tying that more in with health. New ingredient trends, again, that comes into the thing about speed of innovation and capitalizing on trend. Consumers are wanting new ingredients and new things to market all the time. And they know what these ingredients can do because they've become so educated. And plant-based beauty, you would have seen vegan has popped up everywhere, not just in terms of food, but in terms of this industry as well. So now you're seeing packs all over the place with, you know, vegan-friendly, 100% cruelty-free, this whole kind of drive towards plant-based beauty. That just gives you some context in terms of what we're contending with and the challenges that we've got in terms of the products that we develop and how we go to market. So in terms of our division performance, we have 3 divisions. For those that don't know us very well, that goes into contract manufacturing, brands that we manufacture for, private label, where we work directly with retailers on their brand, and then brands that we own. A comparison from the year-end results 18 to 19 in terms of those divisions. So we've had a big upsurge in private label the past 12 months. The previous 12 months, we had a big upsurge in contract manufacturing. It does swing a little like that year to year. The point to make on our own brands is that we've been in a bit of a transition in terms of our priorities on brand and in terms of the retailers that we're working with. We have made a decision this year to move out of licensed brands. We had 2 licensed brands, Emma Bridgewater and Humble. They were margin dilutive. They weren't really adding the value into our business that our own brands were, so it was taking emphasis off us developing our own brands. We have reduced our distribution into the UK discount channel, mainly with specific retailers, where we felt that they are, as you know, the single price pound retailers have had a really tough time. We are really focusing on retailers that are winning, so we've made a conscious decision to move out of those that we feel that aren't winning. We still have a very healthy business in that channel, but with fewer retailers that we feel are stronger, and we're growing within those retailers. So our top discount retailer, we've actually grown 12% year on year. So it's still a very active channel for us. We've just changed the dynamic of it in terms of who we're trading with. But we have increased our high street distribution, which has always been a goal of ours in terms of working on the higher price point brands, which are the ones that you see here. And that's increased 136% in the UK market over the past 12 months. And our branded sales in export markets are up 6.4%. In terms of giving some visibility on our order book versus where we were last year. So our average intake now on a monthly basis is 4 million, up 25% on last year. And our average total order book value at any one time has gone up 29% from 6.6 to 8.5 million. We're very focused on order book. We're always looking forward. That's the driver that we have in our sales team, not the sales that have gone, but the ones that are coming in. So this is a key measure for us in terms of continuing to keep our eye on the ball. So I just wanted to give you some insight into that 136% growth that we've had in high street distribution with our brands that are not in the discount channel. So this would be with mainstream retailers, whether that be grocery or whether that be high street. So the Curl Company, which is a brand we've had for 5 years now, and actually went off to a very slow start for its first couple of years of performance. We sat in a main retailer for about 2 years, just in 90 stores, just ticking over. And in the past 2 years, it really has come into its own. And that same retailer, we're now in 1,000 stores. So that's doing very well. We've driven into 3 new markets in export, which has resulted in the sales revenue of the Curl Company year on year up 153%. We have just launched in Click South Africa. That's quite new. And we've got a bit of MPD coming in this year, which is driving some newness and some new listings. So when I stood here last year, we had this listed in 1 major retailer in the UK. We now have it in 3. And hopefully, fingers crossed, about to hit a 4th in the UK market. So it's come into its own. Curl has really become a trend that is very recognised now. And one of the reasons is that the retailers in the UK have recognised it as a category. And they've now built curly hair as a category. So it's given us more stores to go after, more shelf space, and the ability to get it through the distribution channel into retail better. Because that is often half the fight. If the retailer doesn't understand the product category or hasn't merchandised it well, you're not just trying to fight to get it to the consumer, you're trying to get it on the shelf. And there's been a big change in hair care, and curl has been identified as a big growth area. Feather and Down, which is now in its 2nd year of sale. We launched this just over 20 months ago. We are now in 2 major retailers in the UK. Sales are up 115% year on year. We have just launched into Priceline in Australia, and we've just done a trial in Etos in the Netherlands. And they have just confirmed that they're going to roll us out into 400 stores in September. So that's another nice listing for the brand moving forward. A big thing that's going to happen here in the UK is that we now have a Christmas gift program signed off in the 2 big retailers in the UK. So that will drive growth in the brand to be able to have it not just in single lines in those retailers, but also to have it in their Christmas gifting space as well. Now, Bam Beautiful is not a brand that is in the results that you're looking at, March 2019, because we didn't launch this until May. But it's a brand that I talked about being launched 6 months ago when we were here. So I just wanted to give you an insight as to where this was going. So we launched it on Ideal World TV, We hadn't been in the TV distribution channel before. This was a really good fit. It's exceeded forecasts in the 2 months it's been on television. We've now had 2 main shows that have been repeated 12 times, which apparently is very unusual. They don't usually repeat the same shows with that level of frequency. But every time they repeated a show, the sales were still delivering the same kind of numbers that the live show was. So that's been really interesting. So it exceeded forecasts by 80%. Ideal told us, having met with their senior management team very recently, it's the most successful hair care brand launch that they've ever had on Ideal World TV. And we've done 200K retail since May. And what is really exciting, and I've never been in this position before, we win lots of awards for our products, but we managed to get nominated for all of those awards before we even launched it. So that was quite a nice position to be in. And I think, again, it's a category, hair loss and well-being and how they're interconnected, and this being a natural brand has captured the imagination, not only of the consumer, but of the industry as really being very now in terms of what the consumer's looking for. So Nadia Sawala, who you may recognize from ex-EastEnders and Loose Women, has actually been fronting the brand for us on Ideal, which has been very good for us. We sent all the products to her because she did a big spiel on YouTube about a year ago about losing her hair. And she's got 1 million followers watching that video because it was a very emotional, statement. I'm losing all, my beautiful curly hair. So we sent the products to her, and she'd been using them for 6 months prior to us even launching the brand, and fell in love with the products. She said she was approached by multiple hair care brands, hair loss brands, after she did that review. But we were the only brand that was natural, and we were the only brand that she felt she could align herself to in terms of she's very well-being focused in terms of her lifestyle. She's a vegan. She's into yoga. She's just very that way inclined, and she's been a great sort of asset for us whilst we've launched on TV, which has been quite interesting. The other development is, as a result of being an Ideal, we've been approached by German TV, Australian TV, and TV in the United States. So there are currently discussions going on with other markets about this brand in terms of taking that brand to their markets. And apparently Nadia's got a fabulous profile in Australia too because of EastEnders. So it might be that she's in Australia for us too. In addition to the awards that we've been nominated for before even launching, I'm just giving you an insight as to just being 2 months on the market, the kind of feedback that we're getting from consumers. It's been overwhelming really in terms of how women are really loving this product, and more importantly saying that it's working, that their hair is growing back, they've got less hair loss, they love how it smells, it's not medicinal, it's a beauty product. And just an example there of people saying, I can never be without it, it's a miracle, it's a game changer, and finally something that works. So it's definitely something that we're very excited about and got big plans for over the next 12 months. Digital over the past 12 months has also been very much on our agenda. As Bernard highlighted, we relaunched Creightons.com on a new customized platform. So if you get an opportunity to go and have a look at it, we're very pleased with its functionality. It's definitely making the customer journey much easier. It's a very efficient site. So it's ticking all those boxes in terms of what you need to do technically to make something deliver online. But in terms of transactional sales, obviously that's a priority. But the other thing this is driving us towards is communicating with the consumer more direct. So as well as investing in transactional sales, we're also in team investment in customer and consumer communications, whether that be social media, whether that be with influencers, through the transactional site. We've got a very active program going on with social media. We're now on Pinterest, we're now on Instagram, we've now got Facebook pages for all of the brands. And gradually, this is growing and getting a much bigger direct to the consumer. The other benefit of that is obviously we're getting a lot more feedback about our products from the consumer as well, which is really good. So this is absolutely something that's on our agenda moving forward. And as Bernard's highlighted, definitely on our agenda in terms of potential acquisitions as well to take us to the next level of what's happening in digital. As of the announcement yesterday, we've done a brand acquisition with a skincare brand called Balance Active Formula. What's interesting about this brand is it fills a gap for us. We don't have a brand in the skincare category per se, albeit we make a lot of skincare for other brands and for private label. So we have a lot of technical knowledge on skincare. And we feel that this brand, A, it appeals to a very young consumer. B, it's a very fast moving brand insofar as that it's totally capitalizing on trend and it's completely capitalizing on key ingredient led. So this is going to give us a vehicle through which we can push through innovation very, very quickly to the market. and get to the consumer quicker with new trends. So we're very excited about this. It's got some interesting formats in terms of lip patches, under eye patches, face masks, and these serums. We've also got some ideas straight away in terms of different types of formats that we think could be quite innovative that we could put into this brand. So as opposed to starting something from scratch, this has given us a vehicle straight away that we've got ingredients that we want to move forward with already, that we're going, right, now we have this vehicle, we can do that. The other thing that's really interesting is that it's been on the market for about 3 years. It's done very well. We've done some consumer research and customer research. It definitely is liked. But we have got customers in export markets that this brand hasn't even tried to look at yet. So straight away, there's some low-hanging fruit opportunities for us to get it into the channels that we already are. I think it's got a great opportunity in social media as well, because we've already seen some YouTubing stuff where they're using the mask and getting instant results. And so it's very interactive, and it's got that really kind of lovely transactional relationship with the consumer that we're going to capitalize on. So we're all very excited about Balance. It's in the business now. We start manufacturing it next week. We had our first orders through from customers for next week already. So it's up and moving, and yeah, the team are on it. So in terms of our key drivers, these are identical to what I presented 6 months ago because they haven't really changed. We still are focusing on partnering with winning brands, so contract filling for winning brands and with the right retailers, and continuing to focus on innovation and service. It is definitely the core thing for us that's helping us to continue to win business. Consumer insight, still right at the heart of everything that we do, whether that's private label or our brand. Agility and dependability, even more so with the speed that's happening in the market. And then investing in the team. Our graduate program still continues. I think we've probably taken on 4 more graduates since we were here 6 months ago. That's still a very successful program for us, and spending lots of time as well in terms of internal development and bringing the team up that are coming through the business as well. So the journey continues. We definitely will keep focusing on improving margin. As Paul highlighted, that's been very successful for us over the past 12 months, keeping the team we have working groups for different areas of the business that we get together on a regular basis. So we're constantly benchmarking ourselves and constantly reviewing what we're doing and nudging it forward all the time. Digital, as I highlighted, definitely a key point for us moving forward. Export markets, definitely. We have started our sales process in the USA. That's been going on now in earnest for about 6 months. We are actually showing at Cosmoprof USA for the first time at the end of July. We've always done Cosmoprof Bologna, which is our largest trade show. We've done that for about 6 years, but we're going to do the USA one at the end of July. And we already have some interest with some retailers in the US for some of our brands, particularly Feather and Down and the Curl Company. Haven't even showed them that one yet, so that will be a nice one. Global sourcing, Paul highlighted. We've invested in more resource and more structure and discipline for Chinese sourcing, but not exclusive to China. There are other areas of the world that we're looking at as well. And again, continuing to be consumer focused in terms of what they want in terms of product performance. So that summarizes where we are in terms of our brands, what we're investing in and what we're doing. And Bernard is going to summarize for you.
Thank you so far, ladies and gentlemen. It's always a great privilege to follow these two guys and summarize, and also give Martin his credit on that hair growth launch that we have with Bambutiful, developed by a guy who hasn't even tried it himself on his own hair, but he's doing an outstanding job. So our aspirations are basically to complete the ongoing acquisitions, which are the website that we're looking at and the manufacturing site that we're on, the 11-acre site. And also to look for, within the next 6 months, in order to achieve that 60 million, I think we would do well to buy a brand if we could, and we will find one. Whether we actually nail it or not is another question, because we've done an awful lot of potential deals, but they always fall through on the basis of value. We feel, that a lot of the brands that are for sale are overvalued. So we're hoping we get one that at least it's overvalued to the extent where we could compensate for that overvaluation by something extra that it does for us, like brings it into a new market. For example, in Germany, where we're weakest on our export side, if we could buy a brand in Germany that has access to the retailers, that would be perfect for us. we want to close out on by the end of 2020, calendar 2020, to have sold in that year 60 million. We would like a net profit of at least 5% after tax. Tax will go up next year, of course, because we don't have all those benefits coming forward. And the rate of, I suppose we've nailed that one, rate of return on capital, unless something unforeseen happens. And we want to keep our dividend next year at 2%. And that leads me on, because I can never resist it. I can't resist our aspirations. I want to hit 100 million by 2024. And Pippa hasn't told me how we're going to do that yet. We want to hit net profit after tax of 8% and rate of return on capital of 30% and a dividend of 2.5. I think we can do that. And we will spend quite a bit of money doing it. We're going to spend probably around 5 million on revamping the factory and the machinery, automating, getting artificial intelligence in there, and doing things that means that we can do twice as much, 100 million within the factory area that we have at the minute. And we will have bottle filling and tube filling and jar filling down to a question of 2p or 2.5p, where if we increase the efficiency by 100%, it only reduces it by, you're very competitive at that stage. When you're doing something for 2.5p, you're very competitive, but you still have a capacity issue. So the main thing about innovation there, automation and artificial intelligence, will be reducing the stress levels, the work rate within the company, within the production, and increasing the capacity. And we would also probably spend money on building a warehouse, a state-of-the-art warehouse, where we could bring back our picking and packing. Because I always feel our subcontractors are doing a good job. They're delivering to our customers on time and all the rest of it. But having it in your own control, where it is such an important part of your business, would be good. And it would reduce the cost. Again, I think it's costing us an extra, compared to what it used to cost, it's probably costing us an extra 100 to 150,000 a year, which because we're at that level of business, we can swallow quite easily in order to have the insurance it gives us in delivering to the customer without overcrowding the factory. So that's the basic thinking there, and that would probably mean that by the end of 2024, we'd have spent about 5 million. We'd have a nice set of offices, a nice new factory. We wouldn't be sitting on each other's laps trying to get things done. We're quite crowded at the minute and cramped, but that's part of growing. I would then set out in 2020 to 24 to have brand acquisitions of about 8, which will add about 8 million. And web retailing acquisitions of about 20 million. Web retailing software and equipment would cost us 2 million. By that I mean, a lot of the stuff, we need to understand this business. It's moving very fast, and it requires a lot of investment in understanding it, but it will keep us in the market. And if we're doing 20 to 30 million web retailing, I think it'll justify that expenditure. And particularly, it helps the margin. The margin is good for our final products on our digital sales. So we may wish to raise that. That's just a general statement. I couldn't say it's going to be on the 1st of April 2021 or anything like that, but we probably need 10 million. We can do a lot from within our own resources because we will be quite cash generative if we don't spend large amounts of money on new brands. So we'd probably need 10 million to finance that. And we'd hope to see then web sales of about 30 million in total. Brand sales in the UK, about 15 million. Brands to global retail, 6 million. Brands to shopping channels, 4 million. That's a new area for us, but it's proven quite interesting and successful. Contract manufacturing, 20 million. And private label, UK and global, 25 million. Those are just indicators of where we could be if we continue along the path we are. So I think that concludes our presentation. So it's thank you very much. And we feel really privileged to be here to have this opportunity, and we're taking any questions you have.
I've got two quick questions. In terms of the tenor of the financing for your Peterborough site, you said you have a margin of about 1.8%. What's the tenor of that facility?
We're looking at a 15-year term loan, a 5-year initial period on the loan.
And it's 80% LTV.
Yeah, 80% loan to value ratio.
My second question is that as we sort of go through the journey of taking BAM beautiful products to the market, obviously we're making statements here that is a miracle, it works, and and other sort of statements. What level of evidence and proof has to be provided so that we don't come across difficulties of over sort of claiming the
Sure.
properties
So
of the
when it took me 3 years to bring this brand to market because it's a natural brand in an area that is traditionally not natural, insofar as that hair growth ranges are usually chemically based, and they're effective, but they're chemically based. So it took us a long time to find a combination of natural ingredients that would do the job. 2 independent 100 women studies over a 3-month period, over an 18-month period, blind studies, to have the data to prove that this works. And also the levels of the ingredients that we have within these products. Trust me, it's been an interesting journey. You don't get on these TV shopping channels. It took us a year to get approval with Ideal World because they're very sensitive about advertising standards authority, and you can't say anything that can't be proven. So it really has put us through the rigor, which actually I've been happy to go through because for me, it just gives the range more credibility in terms of its success and in terms of its performance. So I don't know if that answers the question. So it's a combination of the ingredients and the testing.
I think also that it reflects the strength of Martin's team in terms of product development. This team always delivers a result and makes sure we're secure in what we claim as part of that result. So we're confident in that. But some of these things are just things that have been said by consumers' statement. It's not that we're saying it's a miracle. It's the consumer said it was a miracle, and they have produced the evidence in terms of their hair. Whether they're wearing a wig or not, we don't know. But
the way we started developing the product was just by being very selective about, well, what are the best materials that we want to use on the market? And there's one material, the turmeric extract. The turmeric has become really popular over the last probably 6 months, 12 months. But we were working with it probably 2 years ago, and it's, I would say, one of the probably top materials that we've come across in that period of time.
Might see that pop up in Valentine's shortly.
Yeah.
As an example.
And it's delivering all of the attributes that Pippa wanted from the brand, particularly the level of let's say natural materials. We've followed an ISO standard and working to the level of natural materials that are in the product, and so we haven't there are quite a few brands on the market where I won't say they've made up figures, but they've used a lot of imagination to get where they've got to with the total natural levels. Well, these are following an ISO standard, so we've worked out.
Thank you.
Okay.
Sorry, just picking up on my friend's last point, are we 100% sure that this is bulletproof, that if you put this tried and tested and it's a miracle into the advertising, are we 110% sure that that's safe to do? Because I imagine that if you get it out onto the shelves and the product has to get pulled because somebody at the advertising standards doesn't like it, that could be a major hit to the company.
Of course. Something like a consumer giving a 5-star review that says it's a miracle would never be something that we would put into advertising per se when you're putting it into the market. And the market understands and is very clear about consumer reviews. And so they don't see that as an advertising thing, it's just a reference. I mean, that's what Amazon's built its business on, is consumer reviews and star ratings. So this is exactly the same. It's just this industry is now built on what other consumers think of the products. In terms of this product doing what it says it does on the can, if you like, in terms of the actual product, absolutely. We have taken this product through its rigors, through Martin's R&D team in terms of testing and in terms of consumer research, to make sure that the product works.
Yeah.
And if you look at the tried and tested results, which we have the details of, and we do put on point of sale, it says 96% of women, 86% of women. So it's not saying no product is ever going to be 100% for everybody, but it's giving results that say that this is an effective product for a large proportion of people. Much like the 83%, the study that we did, the blind study with a independent test house on the pillow spray. We did a 3-month trial again with 100 people, and 83% said they fell asleep quicker under controlled conditions. So it's, nothing's going to be 100%, but you have to give that data.
Thank you. Another quick question from me, if I may. I think you mentioned at a previous meeting last year an aspiration to hit operating margin of, I think officially it was 5%, but there was a, who knows, aspirationally we could even get to 7%. Am I right in thinking that we're already at 7% if you split out the revenue on a half-two basis? I think we're virtually already there.
We're not far away. And we're confident we can do it by the end of 2020, because that's the aspiration. So we're most of the way there. What are we at in the last 6 months, Paul?
I haven't actually done that comparison that you've done, but I could well believe that we are delivering that sort of figure now, because we're looking at 6.9. So there's no reason why, as we the operational leverage of the business shouldn't give a return as we add more sales and more brands, and be able to deliver a higher return on the operating profit line. We have. We have built quite a good structure now that we've got in place that we can build the business on.
Just following on from the margin question just now, that what could be the sort of maximum margin do you think realistically that the company could get to? And presumably if you cut back on your own brands, that's limiting the sort of margin figure that it could go to. And what, I know there's a figure here of 20% of own brands currently. What would you like to get that back to in due course to?
I think we've always stated we like an aspiration of balancing the three stools, if you like, to the leg we've got, and have a third of our business on our own brands. Our own brands, we obviously generate typically a higher gross margin on these particular brands, but they require support to support them in the market, advertising, etc. Less so in the discount end of the market, where the value market, where we're selling on a price point, and it's got to be the product.
Can I just?
Yeah.
The last aspiration is 100 million, and we're talking about sales of at least 30 million of brand within that. So we're always aiming to keep our brand sales, our own brand sales, at least 30%. Now at the minute they're a lot less than 30%. I think they're 20%. So. But the aspiration is to keep them at 30%, because that's where you that's where you build your equity. If you ever wanted to sell the company or wanted to sell brands, there's a lot of equity.
I mean, the pace of private label growth over the past, private label is very much back on the agenda. That's why I say these three things rotate all the time, because you're working with retailer agendas, and retailers have gone big time, backed off brands and are back into private label in a big way at the moment. They weren't 2 or 3 years ago. They've now realised they're all price fighting, and now they all want private label as a way to differentiate. So the bounce we've had in private label, because we're well positioned to take that, is the growth that's happened. So brands have suffered a little on the listings. We haven't lost listings per se, but it's been difficult to gain listings, because literally you're walking to retailers, we don't want brands at the moment, we want private label. And that's the decision that they make. Now that could change again next year, it could change again. But the other thing that I've said in several presentations before, there's an assumption that brands make a better margin than contract manufacturer and private label. That isn't always the case. If you're going after the right kind of contract manufacturing business and the right kind of private added value business, which is what we do, you can still make some very healthy margins in those arenas as well. And some of our private label business is very good margin, because we're not supplying the bottom end of the market of private label.
So I'll just very quickly finish that off. You'd like it to be equal.
Yes, of course, yeah.
And how soon before it gets back up to that level, do you think?
Well, if we acquire another brand of 4 million and we continue to be successful with these launches, I think it would be within 18 months.
The stock levels at the end of the year have obviously artificially increased because of Brexit concerns. What do you think since you've unwound them, what is the true underlying stock increase, would you say? If it was 5.5, it's gone up
it's
to 8.
probably around about £1 million from last March 2019 to where we are now. We are always a business that focuses on service to customer, and we will always tend to overstock compared to some of our competitors, because we feel that actually being able to deliver and respond quickly is a significant part. So we do tend to maintain a healthy stock level to make sure we can supply customers. And that's a conscious decision.
So apologies in advance for this question, because you must be terribly bored with it, but I'd still like to hear, what impact would a no-deal Brexit have on the business, given that you're trying to export more and you import raw materials, etc.?
Do you want me to? I'll start. I mean, there's sort of three areas that when we started doing our Brexit planning a long time ago now, we looked at. One is people. We've got a high percentage of, I think we've got over 50% of our workforce are European nationals, 13 different nationalities. We have seen a little bit of a drift back, but not as big as we thought we would. So that seems to have stabilised. So we're not seeing that. But we're also focusing, as Bernard mentioned earlier, we're looking at how we can manage with fewer people, because the market's tight anyhow for employment. How can we boost output and efficiency, which we've done quite well, but look at ways of continuing that by automation will be part of the way forward. So we don't see that as a massive risk to the business now. The first other cost was, duty, 6.5% on plastics. We only know of, there's only one plastic tube supplier in the UK that can manufacture. They couldn't keep us supplied alone, so they're not very big. So we have to import tubes from Europe primarily, or some from China, Far East. 6.5% would have been a big cost to us. The government stepped back from that and said, well, we're going to waive duty whilst we sort out the long-term trade arrangement. Duty going the other way is not so bad on our products. 1% is the average increase in the duty of our products to European-based customers. We'll be able to absorb that within our business. So we don't see that. The last area is transport across the channel, really. We're well placed. We've got all the TSP and all the regulatory things in place we've got. I think the 6-month breathing space has given the supply chain, because I think it was all coming up as a deadline. I think the supply chain has had a better chance. The haulage companies, international companies importing into the UK have all had a chance to get the business together. So again, we may look at some Brexit building, but nowhere near to the extent we have done in the past. We feel as though the supply chain is better placed to deal with that. So those are the three big areas that we focused on. And
it's like a competition for us, just give us the Brexit and we'll see if we can deal with it faster than anybody else. That's how we work. I mean, it's just everybody's has the same problems. Can we do it better than anybody else? Because everything we do is competitive. It's hard to get into the haircare business, but we sell 3 units out of every 100 is our product in the UK, and shampoo and conditioner after 6 or 7 years. So that's it doesn't really matter to us whether we're in Brexit or out of Brexit. It matters how we deal with the situation at the time.
Sorry, can I just get some clarification on the slide that you have up there so the 35 million of spending is up to 2024 from today, is that right?
Yeah.
Right, and then
it's not a budget. It's just what we, this is the gut feel.
And then on the breakdown of the sales in 2024, obviously in reality is always different, but am I not right, that's 55 million of branded product? Is not everything through the globe on the website, is that all
that wouldn't be
branded?
The 30 million on the web wouldn't necessarily be our products. I mean, the website that we're looking at the minute, it turns over 8.5 million, but it turns over in Kerastas, it turns over in fragrances. You buy in and you sell. It's about getting on it, they have a 400,000 database. They have a conversion rate of 7.5%. It's getting that mechanic so we can actually do it and deal. So we become retail. I mean, we're virtually retailers at that stage.
Okay, so you're selling what product that you've manufactured under a different brand, or just completely
we're buying,
third-party products?
buying and selling other
products
people's
selling
brands.
them on the website.
As well as having a vehicle to put our own brands through.
Yeah.
Okay.
I mean, you don't want to be, I just feel that some of the retailers that are obviously failing at the minute will have probably failed in 4 or 5 years' time, so we better have our own retail set up. Retail's just changing, and we want to be there. And we don't know how it's going to change. But if we don't understand how the platforms work, how artificial intelligence work in those areas, how you make sales, how you warehouse, how you distribute, I think we'll be in a much riskier situation than one where we spend a bit of money, get in there, know how it's done. We can move out of it. So we kind of do things where we spend enough to know about it without taking any great risks. We can pull out of it if it doesn't work.
Hi, I'm just interested in the private label and contract manufacturing parts. How vulnerable are you in terms of the concentration of relationships, and how long are those contracts for? I mean, are they 1, 3, 5 years, or can they pull out on a very short notice?
Firstly, retailers never give a contract. So try and find any retailer globally that will give you a contract, because they just don't. But if I said that our average...
Vulnerable then?
No, if I said that our average relationship with our private label retailers we work with is 10 to 15 years in most of those relationships. There's some new ones in there too. What is interesting about private label is the people that look after those private label accounts in my business are viewed by those retailers as their employees. You're so embedded in their strategy, managing their brands. Because we don't do low-end churn, I mean, I refuse to participate in e-tenders, for example, for low churn private label business. That's where you're vulnerable. We're always making sure we're adding value to what we're doing. So most of the private label brands that we do successfully are brands, and we manage them as brands for the retailer. So we're constantly adding value as a partner. They don't view us as just a manufacturer. They view us as an innovator, because we're always taking new ideas to them. They view us as people with consumer insight and market insight, because it's very rare that the retailer says to us, this is what we want to do. We're often going to the retailer and saying, this is what you should be doing. So there's a partnership and a relationship there that isn't just about trading and filling gunk into bottles. It's much wider than that. In fact, I have products I don't even manufacture that are in our private label portfolio that are very successful. We don't even manufacture them. We pull them out of other manufacturers or other countries for those retailers.
In simple terms, basically, we just make sure they can't do without us.
Yeah.
That's just basically it.
Yeah.
Overseas sales sort of up 9%, which compared to the rest of the business is relatively pedestrian. Currency is fairly weak, so why is it not growing even faster?
A bit of a change on our part as well, insofar as that we've been transferring from distributors to direct to retail. So our most successful countries where the growth has come from has been direct to retail. We had more of a distribution model when we first started in export, and I think it's very limiting. I think the days of distribution in export are very limited. Many good retailers out there want to deal direct, so we've been nurturing those relationships. And 9% growth in brand sales would be good by anybody's standards. That's a great number for branded growth. What you're seeing with private label growth in the UK is exceptional because of the agenda of the retailers in the UK right now. And we've been well placed to move quickly and take advantage of it. That's why we like our three-legged stool, because you've got to move with the changes, not with just the consumer, but with retail. And retailers globally have also got a private label agenda as well. So actually, we've got some nice global sales in the private label number that actually we haven't split out. And we've got private label global sales going on with some retailers, because again, they've said no to some of our brands and they want private label. So we're there to take advantage of either situation, and when they want to tip back to a brand, that's what we'll do. So it's having that flexibility all the time.
The relationship between the company, the main shareholder, the Peterborough site, could you just repeat that? And who's giving the money to whom?
I mean, I've been fairly heavily involved in this. It is a related party transaction. William McElroy's our largest shareholder. It's his company that owns the site. He bought it quite a few years ago long after he became involved in the Peterborough business, and Creightons bought the business in Peterborough. The site came available. William stepped in and bought it at that time. Part of his business is property ownership and development. He has always indicated to us that when the opportunity is right for us, he would be a willing seller. The valuation's independent. We've had an independent valuer on that, so the price has been supported by an independent valuer. And all of that, if you like, information and background to the price we've agreed will be going to shareholders. The impact on the business is both, apart from the initial term loan, is both cash and profit enhancing. But the site, if people have been to Peterborough, it's got about 4 or 5 acres of land at the back of the site. It's landlocked, and it gives us lots of opportunities to look at developing the business for the long term in total security with the ownership of it. So hopefully that gives you a bit of background.
So the site is quite big, the whole site.
Yes.
And I seem to remember that you're one end of it. But are you talking about buying the whole site, which is occupied by other tenants?
Site.
There's no other tenants.
There's no other tenants on Occupy. Well, there's 2 telephone aerials that are tenants. So we're buying, those will come with that all.
There is no other tenant. It's a lot of it used to be warehousing. The warehousing is no longer there. So there's flat concrete acres, 5 acres of flat concrete.
Well, right beside where you're filling the tubes.
Yeah. Mm-hmm.
Yeah.
All
right.
So we could sell it for development, or we could develop it ourselves. Not that I don't think we want to get into development, but there's lots of potential to it. But it gives us the security of it gives us the advantage of being able to invest in the property there. Whereas when we're a tenant, did you want to fix the floor? Did you want to do this? Do you want to do that? When you're going to be out in 3 or 4 years' time if you can't renegotiate the lease. So I think this is good for us. It reduces the cost per year, and it gives us the opportunity, if we wanted to sell off part of that land.
Makes sense.
I think it's good.
Makes sense.
What rent are you paying?
£3.50. It's about £3.50 a square foot.
I think when we've completed negotiations with the landlord and we've gone through the regulatory procedures, we will be coming back to shareholders with the related party transaction and a prospectus for you to review. And that's probably the right time to go into a lot more detail than we can at the moment, I'm afraid. But okay, are there any more questions from anybody? In which case, thank you very much for coming.
Thank you very much, ladies and gentlemen.